Last week, we went over the top 7 concerns when buying life insurance. This week, we're going back to the basics. This is Cash Value Life Insurance 101. What is it? How does it work? We're going to address the fundamental understanding of these products. So stick around. This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And my name's Jing with Tax-deferred Millionaire Club.
All right, Jing, Cash Value Life Insurance 101. When it comes to cash value life insurance, we're basically going to talk today about mostly whole life and IUL, but what we have to discuss generally will apply to all cash value life insurance, which also includes variable life insurance, universal life insurance, and guaranteed universal life insurance. Of these topics, what is the one underlying thing that is the same with all cash value life insurance?
Well, the fundamental thing is a permanent life insurance, which translates to permanent death benefit.
Exactly. All of these things do have a permanent death benefit, although the underlying insurance may be based on whole life or annual renewable term insurance. It's still considered permanent because it doesn't end. There's no end date, but the costs will vary potentially throughout the life of the policy. So, one of the key aspects with cash value life insurance, permanent death benefit. Most people are familiar with level term insurance, and that one might have an end date. Those are considered temporary death benefits, not permanent. So, cash value life insurance, permanent death benefit. What else can you tell me about cash value life insurance?
Well, obviously, it all has cash value, right? We want to have a plan for the cash value. It varies for whole life IUL or VUL for the cash value.
Yeah, how the cash value grows is very different among all of these different products. Your cash value on your variable universal life is going to be based on stock market growth or the mutual funds that you're invested in. Inside of that, in index universal life, you're going to choose among the different index options or fixed account. In universal life, you basically just have a fixed account that it's going to grow with. And in whole life, it's going to grow based on the profitability of the insurance company. If it's a participating type of policy, which means it's going to participate in the dividends of that whole life company. Otherwise, it could just be some guaranteed rate that they determine if it's not a participating index loan. The other thing to understand about the cash value in these policies is the cash value represents the current value of the future death benefit. How these get calculated, eventually that cash value is going to equal the death benefit when the policy gets to maturity. But it doesn't just magically happen at the age of 121 or 105 or 99, whenever your cash value life insurance is scheduled to mature. It happens little by little. And that's usually where the guarantees come in. The cash value is going to grow based on those guarantees because it's going to equal that death benefit at some point in the future. So we think of the cash value as the current value of the future death benefit. The longer you own this policy, the greater the cash value inside that policy because it has to increase in order to meet that future death benefit.
So when that two value aligns together, the cash value and the final death benefit, we call that endowment. That's the terminology we use. That's why we also don't want the modified endowment contract. We mentioned several times the MEC. That's when the cash values exceed what IRS allows us to put into the policy. It makes this policy modified endowment contract.
Correct. Good to bring up the MEC. There is limits to cash value life insurance. All of these cash value life insurance products that we're discussing, one of the fundamental things about them is there's a certain amount of money that the government will allow us to put into it and still have it be considered life insurance. If you put too much money into it based on your death benefit, it becomes that modified endowment contract that Jing was talking about. Great point there. We talked about how the cash value builds. We talked a little bit about the different product types. Let's address how we can access the cash value. There's a number of different ways. that one can get to that cash value that's built up?
There's several ways. One is just do the withdrawal. It's first in, first out, meaning all your contribution, the premium you pay, if you withdraw from your cash value, you will access what your previous premium you paid into. And after that, it will be whatever the growth of your cash value. Or most of the case, we suggest our audience to go with as a loan to access your cash value. But also remember, this loan is using your policy as a collateral with your carrier. So you get a loan based on because this is a permanent policy, it's an asset for you. So the carrier will allow you to access to certain percentage of your cash value as a collateral to give you the loan. You can take the loan out because it's a loan. Yes, you do pay the interest, but there's no tax. You don't pay personal income tax that year.
Correct. And there's a couple of other ways to access cash value. One, you can just surrender the policy. If you just give it up, they'll cut you a check for whatever the cash value of the policy is at that time. Another alternative is if it's a dividend-paying company, you can choose different ways to pay out that dividend. Normally, we'll just use that dividend to buy paid-up additions, which are little miniature whole life policies, but you can choose to get that dividend as a cash payment, or you can grow that dividend in a side account as well. Okay, so we talked about how the cash value builds in each of these, whether it's by dividends, guaranteed growth, fixed account, or the growth of index options or mutual funds. But what is the tax implications of how the cash value grows inside of these policies?
Let's talk about the death benefit first, because it's a life insurance. It falls into the 7702 IRC code, Internal Revenue Code. So there's no personal income tax of that death benefit. When the beneficiary gets the death benefit, there's no tax complications. There's no tax for the beneficiary. In the meantime, because it's a death benefit, it is actually subject to the estate tax. So there's ultra wealthy people, they set up the ILIT, irrevocable life insurance trust. In that case, it's a trust. The death benefit will not be subject to the estate tax because it pays into the trust itself.
Correct. And then the cash value itself is going to grow tax deferred as well. So not only do we got this tax-free death benefit to look forward to in the future, or at least the beneficiary of the policy gets to look forward to that tax-free death benefit, but throughout the lifetime, the growth happening inside of it is happening tax deferred. And there are certain ways to access it that we can get to it tax-free. But if we do access it in a way that does get taxed, how does that get taxed? Is it taxed as long-term capital gains or as income tax?
It will be personal income tax that year when you access to the cash value. So pay attention if you access a large sum of money after your base, which is the one we talk about first in, first out, you need to budget, you have to pay the tax on that portion.
This is why it's a good idea to work with a knowledgeable agent, because they will help you plan ways to access that cash value and ensure that it stays tax-free. Normally, if it's a policy that it makes sense to do the withdrawals first, we'll withdraw up to the basis and then look to do loans. And if it's a policy that we could potentially be earning arbitrage on loans, we might just take loans from that right out of the gate and not worry about the withdrawals at that point.
That's actually what I did. Because I'm doing the real estate investing and I want the early cash value, I started doing the loan immediately. As some people want to leave it for a few years and then tap into the cash value, but I did immediately.
Well, those of us that are practicing infinite banking love to access our cash value through policy loans on these policies. Doesn't matter what type of cash value life insurance, we have really good terms from the insurance company to access the cash value of these policies much better than we can get anywhere else. That's why these serve as the backbone to our infinite bank. And like you, I borrow heavily against my policies. They make up a fundamental backbone to my overall financial plan. as it sounds like it does for yours as well.
For sure.
The last thing that I want to mention when it comes to the very basics of cash value life insurance is the potential surrender charges that may apply early on in the life of some of these products. The insurance company puts out a significant amount of money to sell you that policy, whether it's through commissions, the expense of underwriting, ordering medical exams or medical records. They don't charge you for any of that upfront, but they will charge you over most likely a decade in order to recoup those expenses. They want to make sure that you're making premium payments and keeping that policy for that whole time so they can recoup those expenses. And that's where the surrender charges come in. So just know in some of these products, there could be some surrender charges, which only apply if you actually cancel the policy or withdraw your money before the end of the surrender charge period. Otherwise, it just limits your access to some of the cash. You don't incur the charge unless you're taking that money out of the policy. And with that, we're going to wrap up Cash Value Life Insurance 101. If there was anything that you think we missed in the basics, send us a comment, reach out to us, let us know. We'll probably be addressing it in a future video. But if it's more than just the basics, we may have already covered it in some of our other videos. Be sure to check out those other videos. Do you have a call to action for our listeners this week, Jing?
It's time for this week's call to action.
Yeah, definitely. I would like to call for booking a call with me. I want to show you what I did for my policy, how I use it. I do not have a very good year the first year, but it doesn't really matter. I'm in that for the long term. I want to show you a real world example how this IBC can be utilized for real estate investors.
And Jing is referring to her IUL. And she didn't have very good index performance in that first year. But yeah, as she said, it doesn't really matter. When you're in it for the long term, there's going to be ups and downs inside some of these products. Will they work in the long run? And can it work for IBC? Talk to Jing about that if you have some questions. And with that, it wraps up this topic today. Next week, we're going to bring you the great debate, permanent insurance or term insurance. Should you just buy term and invest the difference? That's really what that argument boils down to. Well, we're going to address that next week. Be sure to join us for that. I thank you for joining us. My name is James Barber. I'm your Oregon Cash Flow Pro. You can find me on YouTube at Oregon Cash Flow Pro, and I'm licensed for life insurance and annuities across the country.
And my name is Jing. I'm the host of Tax-deferred Millionaire Club. You can scan the QR code to join that free community. I'm licensed in multiple states, practicing life insurance. Happy to talk with you, meeting with you virtually online.
Thanks for joining us. We'll see you next time.
Talk soon.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.